In today's agenda, I will cover growing your team, introducing new product lines, adding commercial vehicles, creating a board of directors, and increased exposure to data breaches. Then I will turn it over to Paul to discuss identifying your need for funding options, your best funding options, and how to prepare yourself to apply. Then we'll open it up for Q&A. So without further ado, let's get started. Growing your team. The rewards of growing your team include scaling your business, being able to delegate more responsibilities, and utilizing people's strengths to grow the company. You can grow your team by recruiting networks both online and in person. Examples may include LinkedIn, career websites, posting signage, and offering referral incentives to your existing employees. Next, be sure to clearly define your interview strategies to pick the best candidates. Beyond just having the job description, know the characteristics and skills you care about most. Then, try to align the people you are hiring with those that best complement your existing employees. In order to retain top talent, offer attractive benefits. Beyond just PTO and health plans, find ways to make your benefits stand out. Pet-friendly workplaces, gym and laundry subsidies, covering lunch or breakfast are all ways companies are getting more creative. Finally, conduct extensive training so everyone understands their role within the company. After hiring, onboarding is the most important thing you can do. The goal to get new hires up to speed as quick as possible. Depending on your company's size, a new hire orientation that allows employees to meet with leaders can effectively help everyone understand the mission and how the teams work together. The risks growing your team include high turnover, low retention, increased workplace injuries, and employment liability claims such as harassment, discrimination, and wrongful termination. The key policies to protect your business include workers' compensation, which is an insurance coverage that helps protect businesses and their employees from resulting financial losses when a worker is injured or contracts an illness on the job. It helps the cost of sick or insured employees' lost wages and medical expenses. Another policy is employment practice liability, or EPLI, which is insurance for employment-related claims such as discrimination or harassment. Errors and omissions is an insurance for negligent acts or errors of the company or its employees. And finally, directors and officers liability covers the board, its directors and officers for negligence or wrongdoing. When you're introducing new products, the rewards include meeting the needs of your growing client base, adding additional revenue streams to the business, and more press exposure and brand awareness. You can introduce new product lines by making sure you understand your target market, and most importantly, knowing that they will be buying a product. Protect your intellectual property and patent your design if needed. If it's a new invention or offering, be sure that no one can imitate your creation. Also, find the right supplier who can meet your business needs. This involves doing research and figuring out timelines, turnaround, materials, and cost. Then market the product and or service to your audience. This last one is important because you could have the greatest product or service in the world, but if no one knows about it, it won't succeed. You have to market it to existing clients and prospects and find the right channels to reach those audiences. The risk of introducing new products include liability associated with recalls, contamination, improper labeling, and product defects. The key policies to protect your business include general liability insurance, which covers bodily injury, personal injury, property damage by a third party, such as a customer. Also, product liability insurance, which covers injury or damage resulting from the use of a covered product. And professional liability or errors and omissions insurance, which we previously mentioned covers financial loss arising out of negligence in providing a professional service. The rewards of adding commercial vehicles include having specialized company vehicles as opposed to just using your own car, having branding on your vehicle, increasing brand visibility through complex signage, company signage, and tax deductions for travel expenses, and being able to deliver more products using bigger vehicles. When adding commercial vehicles, Be sure to clearly write out a policy to specify who is allowed to use a company vehicle and under what circumstances. Also, have a process in place to make sure all your drivers have commercial driver's licenses. The risks associated with adding commercial vehicles include car accidents, bodily injury caused by these accidents, and costly repairs. To protect your company, a commercial auto insurance policy will be needed. These policies will cover third-party injury, property damage claims, as well as first-party physical damage of your own vehicles. In addition, towing and rental reimbursement is available, as well as coverage when you have an accident with an uninsured or underinsured motorist. Be sure to select drivers carefully, as drivers with clean DMVs records will result in lower premiums. The rewards of creating a board of directors include getting insight from industry experts and introducing structure of corporate governance and accountability, as well as advice on the strategic direction of your company. When building a board, look for experience in your industry, clearly define the roles of the directors, and be sure to educate new members about your company and your goals. The risks associated with decisions the board makes include breaching fiduciary duty, lawsuits from investors or governmental bodies, and potential misconduct. When starting a board, having a directors and officers liability policy is crucial for protecting your company, its board, and its officers against lawsuits and the expensive cost to defend against these claims. Having more clients. The rewards of having more clients include increasing your company's revenue, increasing brand loyalty and awareness. You can grow your client base through offering referral to clients to keep them coming back, optimizing your website to increase your search engine ranking and help customers find your website easily, and expanding your marketing efforts, such as creating social media ads. The risk of having more clients, though, include being able to securely store client information to keep it safe from cyber criminals and increase risk to data breaches. It is a common misconception that small businesses are not at risk of data breaches, but in 2017, 70% of all cyber attacks targeted are small businesses. The average cost to recover these data breach costs are $880,000. Obviously, the key coverage to have in place would be a cyber liability policy which responds to these type of attacks. At this point, I will hand it over to Paul Rosen.
Thanks, Jim. Appreciate it. So to reiterate who Fundera is, we are a marketplace for small business financing solutions, as mentioned before. The beauty of Fundera compared to other financing options is that we really can become that one-stop shop for your business, finding the correct financial solution based on your situation, with all of this being free to the business owners, in addition to not impacting your credit score during the exploration process. We know that's top of mind for all business owners. Lastly, aside from financing options, we also have a public blog offering tips and insights to maintain and grow your business, given your specific need. Now, jumping into the different types of financing options that we do have, we have offerings ranging from SBA and bank loans down to lines of credit, business credit cards, as well as invoice factoring. Now, what is the difference between each of the individual products? Which one is better than the next? Why do we offer so many products? And which avenues can a business owner go? Those are all completely valid questions. There are a number of different things that can come into play. However, the most important thing as a business owner that you should consider is what you're using the funds for. Whether you're using it for recurring inventory or a remodel of your location, those are two entirely separate use cases, which can lead you down two different product paths. What we can do now is dive into the different product paths to give you guys some context as to what product might be best for your need. Let's start with some everyday needs, whether it be cash flow gaps that you are waiting for some payments to come in, whether it's payroll that occurs multiple times throughout the year and you need some extra funds by the end of the week, or potentially in some slower seasons. Some other needs that might occur are inventory purchases. Typically, some businesses that come into Fundera, they're looking to purchase some inventory. They're doing that multiple times throughout the year and flipping that inventory for that revenue. What happens when you purchase inventory every single month, every 2 months, every 3 months? You need access to capital consistently throughout the duration of the year. Now, lastly, something that many business owners don't think of, and honestly, why would you? I understand no one really wants to think of the worst case scenario, but emergency funds or rainy day funds is something that every single business owner in America has. As scary as it is, we don't want to come to the reality of it. Life happens, whether it's a hurricane, a family emergency, and so on. You never know when you might need a quick infusion of cash. These are all prime examples that someone should have access to a line of credit at any given time. And at Fundera, we always recommend every individual business owner has that access to a line of credit. Now, the question might be, why is a line of credit the best product for these scenarios and not something else? The reason being is that it costs little to absolutely nothing to have access to a line of credit. It is meant to be there in the background for when you need access to the funds. Additionally, you can draw as much as you want from the line of credit up to your approval amount. Now, for some context and an example, if you're using it to purchase some inventory and you need $20,000, but your maximum approval is $100,000, you can only draw the $20,000 if you need. Once you purchase your inventory, flip this for revenue, you can pay down the line of credit and only pay interest on the $20,000 that you drew versus the full $100,000. And you're only paying interest for however long you have that outstanding. You'll have access to this line of credit in perpetuity, which makes this the best product for these specific type of use cases. Now, on to different types of use cases, some general working capital, whether it's hiring new employees, some marketing campaigns, equipment purchases, or simply refinancing some debt that you had previously. While you can continue to use your line of credit if you think this is a recurring need throughout the year, which a marketing campaign or hiring employees can fall into that bucket, or if this is simply a one-time expense per year and comes up few and far between, a term loan is a much better product for this use case. The question becomes, why is that? The reason being is that generally speaking, term loans are a much cheaper product for a business. They're cheaper because you receive a lump sum of cash deposited into your bank account and have a set scheduled payment over the course of a certain period of time, whether this is a 1-year term, a 3-year term, a 5-year term, and so on. With these loans, the lenders, whether they be banks or alternative lenders, know exactly when your payments are scheduled. Therefore, they can calculate that into their underwriting model versus a line of credit you can draw whenever you would like. So inherently, it increases the risk slightly for lenders, making the term loan a much cheaper product. Moving on to a little bit of the unicorn of financing in the small business space, long-term loans and SBA or bank loans. Of course, this is what every business owner dreams of. And honestly, why not? They're going to be the best products in the market. You can use these loans for various reasons, whether it's expansion capital to remodel a new location, hiring employees, large equipment purchases, or one-time large purchases. Now, why am I emphasizing large? The reason being is that because these loans usually take a bit more work to get through the process. As you get qualified, the terms are going to get better. They can stretch out to 10 years and get as low as 7 or 8% on the rate. Now, in order to qualify for loans like this, while I know this is a dream for many, it does come with a bit of parameters, but it's not as out of reach as many people may think. There are some key things to think about when you're thinking about this type of loan. At a high level, we're looking at a minimum of 2 years in business, a strong credit score in the high 600s or 700s and above. In addition to that, looking for multiple years of profitability on your tax return. Now, of course, there are many other factors that come into play, but that gives you a general baseline of what these type of lenders are looking for. The biggest sticking point when looking at those general parameters that's most confusing to business owners is the profitability portion. What a bank constitutes as being quote unquote profitable is what is legally on your tax return documents. Now, I completely understand that you might be sitting there thinking, my accountant told me to write off certain expenses to show a loss or a low profit so you can pay less in taxes. I totally get it. I would do the same. Who wouldn't? Taxes are brutal. However, unfortunately, it's a double-edged sword with the banks and longer-term lenders, as they do require that profit on a tax return. It's relatively black and white with them. So our general advice at Fundera to business owners, if you're looking for the best terms on your loan, keep your credit high, show the biggest profit you can, even if it's against your accountant's will.
Thanks, Paul. Appreciate that. Now we're going to open it up to Q&A. Oh, sorry, Paul.
No problem at all there, Jim. Now, if you're in the market for financing, there are just a few things that you should consider prior to exploring. As we discussed, there's various routes that you can go with your products. So you ensure that you have all the right answers and make sure you thought about all the avenues you want to go. It's key to consider a few separate things. What is the general profile of your business? Meaning, how long have you been in business? What is your ownership breakdown? Is it a 50-50 split, or do you own the whole thing? What state are you registered in, etc.? How much capital are you looking for? In what time frame are you looking to get funded? Why are you looking for that much capital, and what are you looking to use the funds for? This is the most important question that you should consider, what you are using the funds for. Some business owners, to be frank, do not like to divulge that information to our loan specialists. We're a little bit vague. At Fundera, we make sure to dive into that question the most. The reason being is that business owners should not think of this as an invasion of your space. We're asking these questions because it allows us to provide you the best recommendation possible given the myriad of different products that we have on the platform. Without us knowing what you're looking to use the funds for, how can we help the business? How can a senior loan specialist help advise you in the right direction? Word of advice, if you're on a call or speaking with somebody regarding financing and they're not asking you these questions, that should be your red flag as a business owner. You want to make sure the product is fitting exactly into your needs, and this is exactly how it allows us to do that. Now, preparing for an application. This is sometimes the daunting part, but it's really not that bad. What documents am I going to need to gather for this individual process? The simple answer, recent bank statements and a possible business tax return. The longer answer, it depends what product we're going to explore. Some require just 3 to 4 statements. Others require 10, 20 different documents. Again, not trying to beat a dead horse, but it comes down to the use of the funds. One thing to be wary, though, of a business owner. If someone gives you quotes over the phone without looking at any type of documentation, whether it's bank statements or tax returns, there is no chance they are speaking with any type of certainty. And personally, I wouldn't trust much of what they say. There are many things that come into play with your financials, whether it's bank statements, the number of deposits, low ending balances, etc. With tax returns, it's the ownership breakdown and profitability. If someone refuses to give you a quote without looking at your financials, rather than getting upset at them because you didn't get an answer, this is actually somebody you should be running towards. They understand it's impossible to do so without looking at anything. Now, lastly, I want to give you all an understanding of the timeline and what it typically takes to complete this process. The perception of many business owners is that it takes a couple of months to complete. And frankly, you're not wrong if you're talking to your local bank. However, at Fundera, we pride ourselves on the speed that we have the ability to fund all of our products in a much shorter time frame. Now, to be fair, depending on what product, the time frame will vary. The process can take as little as 12 to 24 hours, or it can last a few weeks or a month. If we're going for the more sophisticated products like a bank or an SBA loan, they typically take anywhere from 3 to 6 weeks, versus at a bank, it can take a couple of months. So we have the ability to speed that process up. However, if we're looking for something with less documentation and a quicker turnaround, there are fantastic products that we offer from 1 to 5 years that can fund within a day to a week.
Thanks, Paul. Sounds like Fundera has some amazing products. And at this point, we'd love to open up some Q&A. Okay, we have the first question coming. It's how much does the insurance typically cost? And it depends, obviously depends on the size of the company and how many employees the company has, the revenue, how long the company's been in business. But if a company that's just starting out with a few employees looking for general liability can get started as as low as $350, and you can even do that on a monthly basis to break up the payments so it's not as costly. But again, it's based on a lot of factors, including revenue, employees, asset size, and the nature of operations.
Great. Thanks, Jim. I think the next one is for me. How worried should I be about my business credit score? It's a great question there, Eric. In terms of how worried you should be, it can vary. Generally speaking, a healthy credit score is in the mid to higher 600s. We do have options that we have the ability to fund with lower credit scores. The main triggers that you should be cognizant of when protecting your credit are certain credit inquiries. So going back to the beginning of the presentation, where Fundera makes sure that we do not have any hard inquiries, that should be top of mind for every business owner. In addition, it should be your utilization on your personal credit. How often are you using your credit cards? How high of a balance are you keeping? Ensuring that you're paying that down on a monthly basis will make sure that your credit score stays in good standing. Those are a few things that specific business owners should keep in mind on a day-to-day basis when going through their credit score and making sure that's at a good standing. In terms of the second question, I believe that would be for me as well from Ignacio. How much should be in an emergency fund? It's a great question, Ignacio. Again, I don't have a direct answer. I'd love to chat with you about it, but it depends how large your business is. Generally speaking, you should have a few months worth of payroll in that back pocket. So we're talking anywhere from 2 to 4 months worth of payroll in a line of credit. Again, something in case something happens. A number of our clients, especially over the last couple of months being hurricane season, have been impacted by this in previous years, where they had to close their business for a month and a half, and they can't do anything about it. So ensuring that they have the ability to pay their bills that are not going to stop over that time frame is crucial. So that would be my answer for you, about 2 to 4 months worth of cushion. Jim, I think that how long does it take for business insurance should be for you.
Thanks, Paul. Yeah, how long does it take to secure business insurance, I believe is the question. And that's the beauty of CoverWallet. We have an online integrated platform which makes it very convenient, easy, and fast to use. By entering in the information on a very short application form online, we can turn around a quote instantaneous and allow customers to even bind, pay, and have the policy issued all right online within minutes. In certain cases, when an automatic instant quote is not available, we have licensed advisors in all 50 states that are available to secure coverage, and oftentimes it's within a few hours. So we try to make it as easy and efficient as possible for our small businesses.
I think from Shannon, what should a business do if they don't qualify for an SBA loan? Great question. So there are a number of different things. Whether you are not meeting the qualifications in time of business, one key component that we suggest for a business owner to do is start building that business credit. Start utilizing business credit cards to build that up. Potentially open up a line of credit or a term loan to start building up that business credit as well. That will report directly back to those credit bureaus. Once you meet that minimum threshold in time of business, definitely make sure that you're talking to your accountant, showing that profit on that tax return. In the event that you don't show a profit or your credit score is lower, there are plenty of other things and other products that we can get you into that have rates just as low as that, terms a little bit shorter, however, provide the same value to a business owner and get you from point A to point B. There are plenty of people who come into Fundera wanting to get an SBA loan, and why not? Longest term, lowest rate, best product on the market for a small business owner. You have to walk before you can run. This is the story that we tell at Fundera. Is not a one time funding here. We want to establish a relationship with the business owner through the duration of the life cycle when they're looking for funding. We are advisors, not a one-stop shop and see you later, making sure that we're putting in the right product to ultimately graduate you to that individual SBA loan is our goal here at Fundera.
Thanks, Paul. It looks like we have no further questions. I just want to remind everyone that there will be a replay available. And if you're looking for additional information, you can go to coverwallet.com or fundera.com or reach out to Paul or myself directly. And I'd like to thank everyone for attending and for Paul Rosen joining me today. Thank you.
Thank you very much, Jim.